Exuberance turned to despair in 2018. Markets started with a bang, but by the fourth quarter, the Goldilocks environment of 2017 was well and truly buried. The carnage began in China and other emerging markets, followed by developed markets, especially those most exposed to global trade, such as Germany, and eventually to the US, which held up well until a disastrous December when the S&P fell by 9%, taking its return for the year into negative territory. Very few assets produced a positive return in the year, and many equity markets entered bear market territory with falls of 20% and more from the peak. Following the most difficult year and sharpest falls in markets since the financial crisis, risk aversion among investors is high. Uncertainties abound. Yet markets repriced these risks substantially in 2018. All major equity markets fell, yet corporate earnings were strong, most notably in the US with growth of over 20%. So this means equity markets offer much more attractive valuations as we enter 2019. In fixed income, the drop in yields of safe haven government bonds in the market rout has reduced their attractiveness, but elsewhere credit spreads have widened substantially in recent months and now provide much improved yields. The risks are clear for all to see, but we believe that markets have discounted more of those risks than is warranted. Markets have deteriorated much more than the fundamentals. This presents a good opportunity to increase exposure to risk assets, notably in equities and corporate bonds, both investment grade and high yield. And for the first time in several years, the valuation of US equities appears reasonable. The market's overvaluation relative to others has been eroded by its sharp falls in the past quarter. The year began with synchronized growth, low inflation, loose monetary policy and strong corporate profits, especially in the US with the one-off boost from Trump's tax cuts. However, underlying concerns around the US-China trade wars, China's deleveraging efforts to rein in high debt levels, together with the move away from ultra-loose policy by central banks, most importantly of course the Fed, combined to raise uncertainty and increase the prospect of a slowdown in global growth, maybe even recession. More localized but nevertheless material events also cast a shadow over growth prospects, especially in Europe. The increased prospect of a no-deal outcome to the Brexit negotiations and the election of a populist Italian government with high spending plans giving rise yet again to concerns about the sustainability of Italy's debt both rattled investors. As the year progressed, the effect on global trade and growth began to show. China's growth fell to a post-crisis low, Japanese and European growth slowed, and in some cases, including Japan, Germany and Italy, fell into negative territory in the third quarter, while leading indicators in the US point to a slowdown in growth from the strong pace of 2018. This sharp reversal was the trigger for the extraordinary performance of markets in the final few weeks of the year. Developed equity markets, which had held up well until the fourth quarter, fell by close to 20% from the September peaks to late December, as growth was repriced. Emerging markets also fell but reached a nadir in late October, by which time the global emerging markets index had fallen by 25% from its peak in January. In contrast, government bonds illustrated their benefits during market turmoil, with the yield on 10-year US Treasuries falling by 60 basis points from the high for the year of 3.2% in early November to 2.6% by year end. In fact, the return of 2.7% in US Treasuries in the fourth quarter took the asset class just into positive territory for the year, one of the very few to deliver a positive result in dollar terms for 2018. In an environment where growth was sagging and liquidity being withdrawn, credit came under pressure with sharply higher spreads, and investors turned to the classic safe havens, developed market government bonds, gold and the yen. The yen was one of the very few currencies to appreciate against the dollar last year, with a rise of 3%. In contrast, the euro and sterling fell by 5% and emerging market currencies fell sharply. As we enter 2019, the global economy is stuttering, trade wars are in full battle, central banks are tightening policy, investors are battered by the sharp falls in markets, and uncertainty is high. The easiest prediction to make for 2019 is that volatility will remain high, but the real question is how this cycle will play out from here, and whether periods of sharp weakness such as those of the past 3 months should be used as a buying opportunity, or whether any bounce in markets should be used to reduce risk and batten down the hatches for much worse to come. The three big issues set to dominate markets globally are the outcome of the US-China trade wars, the actions of the Fed, and longer term the ability of China to deleverage their highly indebted economy without triggering a sharp economic slowdown. We're currently in a 3-month ceasefire for the trade wars as the US and China try to hammer out an agreement. So far, The noises from both countries have been broadly positive, and it's plainly in the interests of both to reach a settlement. However, with two hardline leaders and the underlying issues going beyond trade into control of intellectual property, cyber security, regional security resulting from Beijing's militarization of the South China Sea, the outcome remains uncertain. On balance, we expect a trade deal to be concluded, perhaps not within the next 90 days, but at least during the first half of 2019. This would be a meaningful reduction in risk for the global economy compared with the past 12 months. Arguably the biggest influence on global markets in 2018 has been the Fed's tightening of policy. Unlike other central banks, the Fed is well advanced in its tightening cycle. With 4 rate rises in 2018, Fed funds have been increased by 2.25% over the past 3 years, and the balance sheet has been shrunk from its peak of $4.5 trillion in October 2017 to $4 trillion today, with an ongoing monthly reduction of $50 billion, a material cut in liquidity in by far the most important global currency. Until recently, the Fed was targeting 3 further rate rises in 2019, but the tightening of financial conditions as 2018 progressed, together with increasing evidence of slowing growth, has led to a more dovish approach. Early in the new year, the Fed signalled a more nimble and flexible approach to policy and a likely pause in the rate tightening cycle as it watches how the economy develops, specifically referring also to the tightening of financial conditions resulting from falls in equity prices. It's now highly unlikely the Fed will lift rates as far as previously expected this year, and the Fed has cut its projections to only 2 rate rises. Even those might not be implemented if justified by the data. The key point is that the Fed is a long way through the cycle, will be very cautious with any further policy tightening, and it's already close to the 3% level, which it regards as neutral. It's important to take into account other policy moves by the big central banks. In Europe, the ECB ended its asset purchase program on the 1st of January, but unlike the Fed, it's not withdrawing liquidity, nor is there any prospect of rate rises in the year ahead. The Bank of Japan adjusted its QE program, but continues to make substantial asset purchases, and rate rises here are a very distant prospect. In both cases, interest rates remain negative. In China, the central bank has been easing policy and making more liquidity available to offset a sharply weakening economy. Policy is likely to remain accommodative as the authorities try to maintain growth in the face of the headwinds. Overall, the pace of withdrawal of ultra-loose monetary policy will be much slower this year than in 2018, and although aggregate central bank policy won't turn to stimulus, it will continue to be highly accommodative by any historical measure. The third big risk for markets is the extent to which the Chinese economy slows as the authorities continue to unwind the credit bubble in the corporate sector while wrestling with the long-term structural demographic headwind, the shift away from investment and exports towards a more consumer-driven economy, and the damage from trade wars. Action taken to date indicates the political imperative of sustaining growth, albeit at a gradually reducing level, and further policy measures to stimulate growth are likely in 2019. China so far has demonstrated an ability to manage the slowdown without triggering dislocation, and the country certainly has the wherewithal to navigate these challenges, and while not without risk, continuation of this pattern seems likely. With the stock market down 25% in 2018, much has already been discounted in share prices. There are, of course, other risks. Geopolitics are an ever-present worry. America first, rising nationalism, advancing authoritarianism cast a shadow over the liberal international order. Problems in Europe, the possibility of the UK leaving the EU without a transitional deal, Italy's seemingly intractable debt problems, the structural rigidities, failure to address the sovereign bank doom loop and to build a full banking union, all point to weak growth relative to other large economies. But in usual EU style, enough will be done to maintain stability and prevent a systemic crisis. The can will be kicked down the road. It's easy for the positives to be overlooked in tough market conditions, yet there are few, if any, signs of capacity shortages, overheating or sharply rising inflation that would trigger sudden and unexpected tightening of policy and presage a recession. Inflation globally remains subdued, and the collapse in the oil price in the past quarter will restrain inflation and provide a useful boost for consumers. Monetary policy has tightened, but the Fed is close to the peak of its interest rate cycle. Rates globally are set to remain extremely low for some considerable time ahead. Liquidity has been tightened, but there are no signs of a systemic liquidity crunch. Although growth has slowed, it remains positive, and leading indicators generally point to further, albeit modest, growth ahead. We therefore enter 2019 with a positive view. The big risks might well have peaked and have anyway been fully discounted in markets. Positives are being ignored. However, market moves in the past year have once again illustrated the benefits of diversification, and this will remain vital in the year ahead. While we're constructive about risk assets after the falls and see no major deterioration from here in the fundamentals, indeed probably some improvement relative to the market's current gloomy view, neither do we envisage an unbridled bullish environment. The risks and uncertainties around monetary policy, trade wars and growth are too great to justify such an outturn. We will therefore continue to build our portfolios with true diversification and resilience around a core in equities, making use of the wide range of asset classes which exhibit relatively low correlation with traditional assets, infrastructure, selective property, gold and liquid alternatives, as well as safe haven bonds as and when yields pick up from recent falls. As we saw in recent months, these assets work well as portfolio diversifiers, providing defensive exposure during the inevitable bumps as the cycle progresses. With careful diversification and the conviction to look through the current gloom, 2019 promises to be much improved compared with 2018 and has the potential to deliver at least mid-single-digit returns, albeit with bumps on the way.